Cient, J.P. Morgan, and Delaware all pulled metal on the same activity date. Not one vault, not two, three named depositories moving out of the eligible category on the same day, while paper silver sat at $84 and change on every screen in the world. That combination does not happen by accident. It is not noise. And by the end of this video, you are going to understand exactly what it means and what it does not mean, because both matter. I am going to show you exactly which institutions pulled what, how the registered versus eligible split creates a delivery bottleneck you need to understand, why paper price and physical behavior can run in opposite directions in the same 24 hours, and what the total open interest picture means for everyone holding any position in this market right now. This channel exists to show you what the CME depository reports actually say, not what financial television decides is worth covering. The gap between those two things is exactly the gap between reacting to a number on a screen and understanding the system that produced it. What just printed in the March 10th activity report is precisely the kind of event this channel was built to explain. 3 institutions. 1 activity date, 768,640 ounces gone from eligible in a single session. If you want to understand the signal before the crowd does, not after it shows up on CNBC, drop the word eligible in the comments right now. That one word tells me you actually understand what category this metal just left. Hit subscribe and drop a like while you are there. The algorithm needs a signal the same way the market does. Give it one. Here is what the data says before anyone puts a narrative around it. Now let me show you the framework first. There are 2 categories that matter in a COMEX depository report. Registered is the metal that has been formally warranted and stands ready for physical delivery against a futures contract. Eligible is metal that meets the purity and bar specifications but has not been registered for delivery. It is in the building, it is real metal, but it is not currently standing at the window. The distinction between those 2 categories is one of the most misread pieces of data in this entire market. The CME depository report dated March 11, 2026, activity date March 10, 2026, prints total registered silver at 78,347,462.573 troy ounces. Total eligible sits at 266,194,339.297 ounces. Combined total is 344,541,801.87 ounces. That is the snapshot. Now look at what moved. There is one detail in the eligible withdrawal breakdown that I want you to hold before I explain the full picture. The breakdown is specific to the bar. We are going to come back to what that specificity tells you about the nature of these moves after I show you the open interest context. Without that number, the withdrawal reads like a logistics update. With it, the withdrawal reads differently. Cient depository shows eligible withdrawn at 603,477.62 ounces. J.P. Morgan Chase Bank shows eligible withdrawn at 159,493.20 ounces. Delaware Depository shows eligible withdrawn at 5,669.85 ounces. Add those 3 numbers and you are sitting at 768,640.67 ounces pulled from the eligible category on a single activity date. Most people skip that line entirely. They look at the total. They look at the registered number. They move on, do not move on, and that is just the surface read. The number underneath it is the one that puts it in context. Total open interest on the May 2026 silver contract was printing 78,474 contracts at the time of these snapshots. Each contract represents 5,000 troy ounces. Do that math out loud. That is 392,370,000 ounces of paper. Obligation sitting against a registered category of 78 million ounces. Roughly 5 paper claims for every 1 registered ounce available for delivery. This is where most people who have never heard the COMEX explained this way start to feel the floor shift. The screen shows you a price. The depository report shows you the structure behind the price. 5 paper claims per registered ounce means the system runs on confidence, not on metal. It runs smoothly until it does not, and when it does not, the exits do not stay wide. Now here is what changes everything in this picture. Let me connect this to the institutional playbook, because what we are watching in this depository data is consistent with how large players manage physical positioning. The documented pattern works like this. An institution accumulates a position in eligible metal, metal that is real, metal that is in an approved vault but metal. That is not yet standing for delivery. While that metal sits ineligible, the institution has flexibility. It can register it and demand delivery. It can move it out entirely. It can use it as collateral in ways that never show up in the open interest data. When three institutions move eligible metal out on the same activity date, there are several possible explanations. They could be reclassifying, moving metal to a different vault, adjusting logistics, or satisfying delivery obligations through a channel that does not require COMEX registration. Every single one of those explanations is legitimate. The report does not tell you why. It tells you that it happened when it happened and exactly how many ounces were involved. What institutions know and retail does not is that the eligible category is a reservoir. And when you watch that reservoir drain while open interest stays high, you are watching two systems move in different directions at the same time. The paper market price is confidence. The physical report price is reality. They are connected, but they do not always rhyme. They profit when you read the screen and stop there. You protect yourself when you read both clocks. Now connect this to the price action because the timing matters. Paper silver was printing a bid of $84.62, ask $84.87 at the time of these data snapshots. The day range on that session ran from $83.02 to $89.54. That is a $6.52 intraday range. In a market with 5 paper claims per registered ounce and 3 depositories pulling eligible metal on the same day, a $6 intraday swing is not a price discovery event. That is a leveraged arena responding to sentiment and dollar movement. The ICE dollar index was printing 99.456, up 0.2 to 5 on the day. A dollar that firms even slightly puts downward pressure on everything priced against it. That mechanism does not require a conspiracy. It is arithmetic. The metal did not get cheaper on March 10th because something fundamental changed about silver. It got cheaper on the screen because the arena was crowded and the dollar ticked up. Meanwhile, the vaults were logging withdrawals. Both things happened in the same session. That is the dual reality you have to hold simultaneously if you want to read this market accurately. Now here is the detail I told you to hold. The breakdown in the eligible withdrawal is specific to the bar, which means these are identified positions, not accounting adjustments. When the line item prints to 2 decimal places on ounces, that is not a rounding event. That is someone counting specific bars and moving them deliberately. CENT at 603,477, JP Morgan at 159,493, Delaware at 5,669. Specific numbers, specific institutions, same day. Now let me show you the delay case, because honesty matters more than cheerleading. Silver is structurally volatile. The open interest we are looking at represents positions held by participants who are not all moving in the same direction. Some of that open interest is commercial hedging by miners and fabricators. Some of it is speculative. When speculative positioning unwinds, it does not care what the depository report says. It follows margin calls, risk limits, and dollar movement. An eligible withdrawal on one activity date does not lock in a price outcome. The metal could re-enter eligible the next day under a different classification. The total eligible at 266 million ounces still dwarfs the 768,000 that moved, and paper price can stay disconnected from physical signals for extended periods before the gap forces a resolution. The bearish case is straightforward. A firming dollar, high open interest that can liquidate fast, and an ETF wrapper holding 528,691,365 ounces in trust means the paper exposure in this market is enormous relative to what moves when people panic. Do not mistake a thesis for a timeline. Now the counterpressure algos can run paper price down on a dollar tick. They cannot re-register the metal that just left eligible. The open interest to registered ratio does not shrink because the screen moved lower. The 3 depository withdrawals are logged and time-stamped. Those ounces moved, and the structure of this market means that every time registered silver does not grow alongside open interest, the buffer between paper obligation and physical availability stays thin. Thin buffers do not stay theoretical forever. Verify the data yourself. Pull the CME Silver Depository Report for activity date March 10, 2026. Look at the eligible withdrawn column. Check the line items for CENT, JP Morgan Chase Bank, and Delaware Depository. Then look at the total open interest on the May 2026 contract. Then look at total registered. Read those 3 numbers side by side. The ones who actually do that verification do not need anyone to explain the picture after the fact. For physical holders, your position is tied to the slow clock, not the screen. Nothing in this report changes the fundamental case. The registered category is still 78 million ounces against nearly 400 million ounces of paper obligation. Hold your position and let the structure work for futures traders. The intraday range on March 10th was $6.52. That is the arena you are operating in. Open interest is crowded. Leverage cuts both ways when sentiment shifts. Manage size accordingly. For ETF investors, the SLV wrapper gives you exposure to the price, not to registered metal. You move at the speed of the screen, not the speed of the forklift. Understand which clock you are on. For everyone watching from the sidelines, the data is public, it is specific, and it is time-stamped. You do not need a prediction. You need to understand the structure well enough to read the next report yourself when it prints. Scenario 1, bullish. Eligible withdrawals mark the beginning of a reclassification cycle where institutional players begin registering metal ahead of a delivery squeeze as open interest rolls forward. Paper price reconnects to physical scarcity signals. Silver moves toward and potentially through the $95 to $100 range on a 6 to 12-week horizon. Probability, 35%. Scenario 2, neutral. Withdrawals are logistics adjustments with no delivery follow-through. Open interest rolls without incident. Paper price oscillates between $80 and $90 as dollar and macro sentiment trade the range. No resolution to the registered versus open interest gap. Probability, 45%. Scenario 3, bearish. Dollar firms further. Speculative open interest liquidates. Eligible metal re-enters the system from alternative sources, and paper price tests the $80 to $82 range on a sentiment washout before any structural pressure reasserts. Probability, 20%. Everything covered here is for educational purposes only. This is not financial advice. Use your own brain. Do your own research. Always, physical will win. The only question is when. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly.